Yeah, so I'm saying after consultation, I was informed that the workings for all the questions, in part 2, you don't have to use a different worksheet. It is not a must. That is what I was informed about. You don't have to use different worksheets when doing the presentation. You can do the presentations in the same, you can do the workings in the same worksheet you are doing the presentation. So that is consultation, which I made from reliable sources. You just do your workings in the same worksheets. So the workings, you just have them aside from presentation. So you don't have to use the 2 columns. So kindly note that carefully. So it's allowed workings to be the same worksheet where you're doing the presentation. You just separate them, but in the same worksheet. So you don't have to open a different worksheet for that. So kindly take that into consideration. So Esther, yesterday you were not there. We did the question on cash flow, question 24. Question 24 of December 2022. And people requested, those who were there yesterday requested that we repeat the same question using direct method. And in the direct method, we only repeat the operating activities because investing and financing activities are similar, regardless of the method you apply. So I will request that we work out that. So I will share the screen. I'll share the screen. So you can see my screen there. So we want to use the direct method of presentation. So you say here, repeat, using direct method of presentation. Direct method of presentation. So I want us to use the direct method. So under direct method, we are only repeating the operating activities only. So you'll write here, shillings were in thousands, millions actually. Shillings were in millions. So we just need 1 column. So operating activities. So you pick here cash received. So let me lay the format, then we do the workings to fill up. So you say cash received from customers, then cash paid to employees
and suppliers.
and suppliers, correct? And suppliers. Then whatever you will get here is called cash generated from operations. Then you finish it up with the tax paid. Tax paid. Then whatever you will get after that is the cash flow from operating activities. So that will be cash flow from operating activities, which is going to be our A. So that one is our A there. So the A we got yesterday should be the same. And what we got yesterday, because I'm still in the same worksheet of yesterday, what we did, this one here, we got 286. We got 286. So in the other format, also you are supposed to get the 286. They should not vary.
218.
218, yes, it was 218. So it should not vary. So tax paid, regardless of the method you are using, tax paid will remain the same. This one here, 62. So I will also still pick up on that. 62. Tax needs to remain the same, regardless of the method. So have that. 62, it remains there. So our concern is the cash received from customers and cash paid to employees and suppliers. So I will do working one here. Remember, investing and financing remains the same, so we will not repeat those two. And allow me to repeat, I've said after wide consultations, I was told or advised that the workings can be done in the same page. So there is no need for you to open another worksheet. There's no need for you to open another worksheet. That is the advice I was given, and that is what you need to adopt even during the exam. So my working one here, will be on cash received from customers. Cash received from customers. That is how you're supposed to go about it. So cash received from customers, how do you work out that? You reconcile trade receivables accounts, trade receivables. For you to get the cash from customers, you reconcile trade receivables account. So you'll start by saying trade receivables brought down. So at the start of the year, you check how much was the trade receivables. So check in the question 2021. How much can you
87.
see? Yes?
87.
Yeah, it was
87.
Yeah, it was 87. Then you add what we call credit sales. You add credit sales. In this question, nobody mentioned credit sales, so I'm going to assume that the entire amount of revenue was on credit. The entire amount of revenue was on credit. So revenue was 473. So in total, we are expecting that at the end of the year, trade receivables, you know, receivables are outstanding debts. Receivables should be 87 plus the credit sales, which is the revenue in this case, to be 560. Skip one line. You have trade receivables, carried down. So carried down receivables, if you check, you will be able to see 95. So we are expecting a total value of 560, but we are being given there 95. So the decrease is the cash received. So cash received, which is the balancing figure there. And cash received is positive, so I need a positive figure here. So it is 560 minus 95. So they received 465. So 465, that is what you bring up here. So you say is equals to, we don't want those manual. So you say is equals to this one here. You pick that, then you enter. So that is the cash received from customers. Nani ako na swali? Up to where we have reached. Who has a question? So no one has a question. We go to cash paid to employees and suppliers. Cash paid to employees and suppliers. So to determine the cash paid to employees and suppliers, what you're supposed to do, you reconcile for employees. Let me have here working two. I've said workings, they have recommended to be done in the same page. So working two, you say cash paid to employees. Cash paid to employees. So for employees, what you do, honorable members, what you're supposed to do, you take administrative. Employees, you add administrative expenses. So administrative expenses, those ones goes to employees, it was 48. There is distribution costs. If you check the question, that was 76. Then now the total of which we are talking of how much? The sum of the two. The sum of the two is 124. Then there were some expenses. Which were classified. They were taken as part of administrative or distribution, but they are not involving actual cash outflow. So you need to subtract them. So you come here and say, less, check for me first of all, note number one. There was loss on disposal of 6 million, which was charged to administrative. So that loss on disposal, it is not cash to employees. Loss on disposal, it was classified as part of administrative. So you need to subtract that amount from administrative. Also, if you check note 2, depreciation charge for the year of 30 was 43 million. So that depreciation equal, because we cannot see it in the P&L, ayonekani, So I will assume maybe it was taken to cost of sales or administrative. So wherever you subtract it, there will be no issue. So less depreciation. Depreciation, you cannot see them in the P&L. It simply means it is part of an administrative there, we assume so. So depreciation was 43. So you will subtract that. Also, there was impairment or amortization. So amortization, okay, how much was it? I can't recall.
10.
It was 10. Yes. Which we got by checking the intangible assets. I can even show it here. It was 50. It was 50 minus 40. If you check the question, it was 50, which dropped to 40. So that one gave us 10. So we are subtracting them because we cannot see them anywhere in the P&L. So those expenses, I hope we capture all of them. Those expenses which you cannot see on the face of the P&L, you will not have any option. You don't have any option but to subtract them from administrative. You can even subtract them from cost of sales, but still you'll get the same thing. So there is always no problem with that. So now it means the net cash to employees, net cash to employees is going to be this one here. Going to be that one, 65. So that is the net cash to employees. So I hope you have understood. So employees, you take administrative distribution. Then you bring all the income and expenses, which are in the question, but you cannot see them in the P&L. If you can't see them, it simply means they have been grouped in the administrative or cost of sales. So whichever you assume it is, perfect. So that is how we go to work out employees. Then now, I want us to check for cash paid to suppliers. So cash paid to suppliers, still under working two. So cash paid to suppliers. Suppliers and equals squeezing. Suppliers. So cash paid to suppliers, you start with trade payables. So you say trade payables brought down. Then you add credit purchases. You add credit purchases. Then you skip one line there. Okay, fine. Your total, you will get a total somewhere down here. You'll get your total there. Then the balancing figure is the cash paid. That is the cash paid, which is your balancing figure. Your balancing figure there. So you will have the balance carried down. The balance carried down. So let's fill, because we have problem will only arise on purchases, but fine. Problem will only arise on purchases, but fine. So payables beginning, you have them down there. It is 100.
Yes.
Yeah, this is 100. Then credit purchases we don't have. But carried down, payables we have 156. So what holds and what makes students to hate this method is now this thing of credit purchases. So credit purchases, you will not be given, but you can get it. You can get it from the cost of sales. Remember, how do we calculate cost of sales? So cost of sales is equals to opening inventory plus,
Purchase.
Yeah, plus purchases minus
closing
inventory, correct? So now, this is the formula you're supposed to use. We're supposed to use in order to get we are going to assume these purchases, all of it is on credit, this one here. So we have cost of sales in our question. So check P&L. In the P&L, cost of sales is 229. So you say 229 is equals to opening inventory. Opening inventory, if you check the question, is 176 plus P. So P is what we don't have, minus closing, which is 123, like that. So it means making P the subject, P will be 229 minus 176 plus 123. So that is the value of P. So P is equals to, so P is equals to 229 plus 176 plus 123, enter. Oh, here's if I gave. Okay. If it can't, then I know what to do. I just remove P, then I enter. 528. It doesn't figure 5 well.
No.
Bodmas must be obeyed. It can't go to 5. 5 is too high for us. Unless we are not observing there. Is equals to 229 plus 123.
Minus 176.
Yes. So it comes to P is 176. So our purchases is 176. So that is what you're supposed to take up here. So it's equals to this figure. Then you enter like that. So it means suppliers at the end should be 276, but the examiner said it is 156. So the balancing figure is the cash paid. So cash paid, I need it as negative because paid is outflow. So you take 156 minus 276. You get 120. You get 120. You get 120. So 120 is what you bring here. So is equals to, no, wait. You know, here is cash paid to employees and suppliers. So is equals to employees, we got that they were paid 65. So you will take 65. That is what the employees were paid. We have to be very keen there. We have to be very keen. So total, let's do this. Total paid will be 65 plus 120. but I want all of them as negative. So minus 65 minus 120. Sorry. Is equals to minus 65 minus 120. Why is it not minus 185? So that is the total paid. And that is the total you should bring here, both employees and suppliers. So you bring is equals to this, enter there. So that is what was paid. So it means cash generated from operations need to be is equals to this plus this one here, 280. So 280 minus that, so that plus the tax, you get 218. Is 218 what we got the other side for A?
Yes.
Yes. So it means we are accurate. It means we are very much accurate. So that is how you do direct method. But if not asked by the examiner, if the examiner is not specific on this method, wachana nayo, it can waste your time, unless this one we have just done on the assumption that you can be requested. You can be requested. So now, let me ask you, this sitting of December 2022, do you have the solutions to these other questions? Because I can comfortably do them for you. Can you confirm? Then also give me 1 minute, kidogo, just a minute. All right, so I was asking before I took that break, will you want to have this perspective we are doing? Will you wish to have all the solutions for all the questions actually? Both part A and part B, all of them, or you have? Pick someone has answered
We
me
don't.
here.
We don't.
We have not revised question 21 and 23. You have not revised 23 and 21. Okay. All right, Veronica. So, can you give me few minutes after class? I can share. Another panel you don't begin. So I can work out then what to me.
Yes, yes.
All right, so that is agreed. So for now, allow me to move forward. So cash flow, ikikuja, mfanye hivyo. Now I want to go to last sitting. So let me stop sharing this one. So last sitting, I think I only have it in soft copy. I don't have hard copy. So let me check. So wait, I'm looking for the question. Meanwhile, start getting the last sitting, April 2022. Start getting that question is what I'm looking for.
(2023).
2023, yes, April. Good. So now, let me see if I can share this. But I know what to do with it so that just a minute, it's opening. Yeah, so let me share with you this question. Yeah, so question 23 of last sitting, question number 23 of last sitting. Question 23 of last sitting. They were saying, I hope you're there. Can you see my screen?
Yes.
Okay. So let me read this question. Then from there, we are not just going to start immediately, because you know, when they start this issue of bringing group consolidation here, the probability of them examining group again is very high, the chances. So I will not just go straight to solve the question. Instead, I will prepare you for 1, 2, 3 before we approach the question. So it says, the following draft financial statement relates to H Limited and its investment companies, S Limited and A Limited, for the year ended 31st December 2022. So we have H Limited, S Limited, and A Limited. So in this case, H is the parent company. I don't know, to this point, I don't know S is, or what kind of an investee. A, I don't know what kind of an investee until I see the percentages. So property, plant, and equipment, they had intangible assets, and also they have investments. Current assets, inventories, trade receivables, cash at bank, ordinary shares, retained profits. Then we have the shareholders' funds there. Non-current liabilities, we have the 10% loan stock, trade payables, bank overdraft, current tax. The following details relates to the acquisition. So the company being acquired, S Limited and A Limited, dates of acquisition, 1st January, there is something not visible there. So 1st January when? 2019, then the other one, 2020. We are preparing the books in 2022, okay? Then cost of investment. So in S, the parent company invested the amount you can see there, and also in A. Then on the dates of acquisitions, the profits were as you can see. Then percentages also as you can see. H Limited also invested in 25 million of the loan stock in S Limited on 1st January 2021. No problem. On the dates of acquisition, the values of the buildings in S Limited and A Limited were shillings 50 million and shillings 25 million above the carrying amount. The values of the building were 50 and 25 above there. Okay. Buildings are depreciated at the rate of 2% per annum on reducing balance. So that is revaluation, the concept of revaluation. The fair value of the non-controlling interest, the purchase consideration, can be estimated from the share prices of S Limited. That was 80 million on 1st January 2019. Perfect. On 1st January 2021, H Limited sold S Limited an item of plant at a selling price of 75 million. No problem. No problem. Reporting a profit markup of 50%. Plant is depreciated at 20% per annum on reducing balance. Sawa. During the year, the company is traded as follows. S sold goods at a selling price of 20 million to H at a normal gross profit margin. Normal gross profit margin. 1/4 of these goods remained unsold at the end of the year. H Limited sold goods at a selling price of 40 million to A Limited, reporting a profit of shillings 10 million. Half of the goods sold to A Limited. H sold goods at a selling price. Sold to A Limited had, let me see the correct thing here. Sold to A Limited had been sold by the year end. No problem. At the beginning of the year, H Limited had goods to the value of 10 million purchased from S in the year ended 31st, 2021. Okay, included in the trade receivables and payables of each, included in the trade receivable and payables at the respective company that follows are the following intercompany balances: due from H to S, due from A to H. Okay. A close check in S Limited's books revealed that the receivables of S had shillings 30 million due from H. A close check in S books revealed that the receivable of S had 30 million due from H. Oh, sour. This anomaly arose because H Limited had sent a check of 5 million to S, but had not been received by S. Now, meanwhile, all the companies had paid their interest on the loan stock. Goodwill were relevant, had been impaired by 20% on cost at the beginning of the year 2022. An additional impairment of 20% of the initial cost was again reported in the year 2022. Okay, no problem. Required, prepare the consolidated statement of financial position as at 31st December 2022. So that is 20 marks. So I think it won't be good for me just to start that question, because I believe some of the things you have forgotten. You have forgotten about some of the things in group accounting. So I need to bring you up to speed with some of the elements in group before even we think of starting that question. So in group accounting, most of the adjustments, so I think you can just take small notes. You can take small notes so that when we go to the presentation of that question, it be okay with us. So the small notes, number one, key adjustments. So I want us to discuss these key adjustments. Key adjustments in group accounting. Key adjustments in group accounting. So these are some of the elements I would want you to master. So number one, yes, be there. Number one, we are going to talk of goodwill. So goodwill is a sensitive area to check. Number two, we shall check what is called unrealized profits on inventory. Unrealized profits on inventory. Also, we shall check the element of unrealized profits on fixed assets. Also, we shall check an element of revaluation. We shall also check the element of non-controlling interest. We shall also check the element of intercompany trading. Yeah, I think, and also you need to check investments in associates, and joint arrangements, e.g. joint ventures. Correct. So in group accounting, for you to work group successfully, you need to have those concepts. You need to have those concepts. You need to have those concepts. All of them, you need to know what they are and how they are treated. So allow me to start with number one. We cannot go to that question blindly like that without passing through this. Some of us have forgotten. So the first thing you're supposed to know are these percentages. So subsidiary, you know, we are just taking small notes here. We do have subsidiaries, we have associates, we have joint, let me just call it joint ventures, like that. So subsidiary is an entity in which the parent is having between 50 to 100% of the shareholdings, 50 to 100%. In associate, the parent is having between 20 to 49% of the shareholdings. Then in JV, the parent is having exactly 50% of the shareholdings. So these two, that is the associates and the joint ventures, we don't consider them during consolidation because the parent lacks what we call control. The parent has no control in those entities. And therefore, where you don't have control, you are not supposed to consolidate. You are not supposed to consolidate for that company. You are not allowed. Because consolidation means the acquirer, which is the parent in this case, has mandates to consolidate. So the parent only consolidates for this one, for the subsidiary. So consolidate. But these two, there is no consolidation. We only consolidate for the subsidiary. These two, we don't consolidate for them. It means their items, whether it is balance sheet, whether it is P&L, we don't consolidate for them. For balance sheet, we only take investment. We check how much is our investment in associate and joint venture, period. You don't take those other operations. The way I've seen in that question, we are not going to be bothered. We are not going to be bothered with those other items there. We are only going to take our investment. If they require us to prepare profit and loss accounts, then we only take into account the profit after tax. You just take your profit after tax and that is all. So associates and joint ventures, we don't consider them during consolidation. That is what you need to appreciate. We only consolidate for the subsidiary. So percentages are very important. So having known that refreshment, I can now discuss, or you know, here we guide each other. Maybe you are very fresh with these things, so maybe I'm just wasting time, which we don't have. But what do you think? It is important for us to discuss these ones first before the question, or we just revise that question straight. Let me see, someone is saying, Jared, what happens when the holding company has voting rights, yet doesn't match the 51%? Yes, I'm answering that right now. I was asking, it is of your view as well. Veronica said, let's do that overview. Thank you. I've said, and I was to mention that. Jared is asking, we have said you only consolidate if you have 51 and above. That is when you are allowed to consolidate. So he's asking, what if the parent is not having 51, the parent is not having 51%, but has more voting rights. You can have more voting rights even if you have 50-50, or even you have less. What happens? So according to IS number 27, allow me to share this as well. So let me do this. I want us to check IS number 27 all together. It's very important. IS number 27. So let me stop sharing this so that I share with you this, but I'll come back there. So wait. I want to share this with you. Yeah, so on my Google, I want us to check what IAS 27 is talking about. International Accounting Standard number 27. Jared, that one will answer. Exactly what you are asking. Let me check if that one will answer me. So in this standard, decline those things. In this standard, will answer what you are asking. Check here. Identification of subsidiaries. They are saying control is presumed where the parent acquires more than half of the voting rights of the entity. Even when more than one half of the voting rights is not acquired, so now that is answering you now, even when more than one half of the voting rights is not acquired, control may be evidenced by power one over more than one half of the voting rights by virtue of agreement with other investors to govern the financial and operating policies of an entity under the statute or agreement, to appoint or remove the majority of the members of the board of directors, and to cast the majority of votes at a meeting of the board of directors. So what that means in relation to what he was asking, even if you don't have control exists at 51%, but the parent may have less than 51, but the parent is the one mandated to appoint majority of the board, to remove the majority of the board, to cast majority of the board votes at the board meeting, then in that case, the parent will consolidate for that company. It is an exemptional case. The parent will consolidate. If the parent is the one having majority of, cast the majority of votes, appoints majority of the board members, and they have the powers to remove, then they will consolidate for that company. Even if the 51% is not achieved, then the parent will still consolidate for that. So Jared, has that answered you to your satisfaction?
Yes.
Correct. So let's go back to where we were. So let's do this overview. Let us do this overview. So the overview here, I want us to start with goodwill. So how do you calculate goodwill? To get goodwill, you take what we call the purchase consideration. Paid by the parent. So the one which is paid by the parent, you take that into account. In case minority, not a must though, if minority was stated at their fair value, you add fair value which I saw in that question, they were stated at fair value of non-controlling interest, you will add to what the parent has paid, then you less what we call net assets. Net assets. So, sorry, net assets. Net assets. You subtract the net assets. Then what you get now is the goodwill. Goodwill is what you get there. So in accounting, that is how we get goodwill. But if the fair value of minority has not been provided for in a question, if the fair value has not been provided for, then you just take the purchase consideration of the parent. Then net assets now you will have to apportion. You apportion using the percentage of the parent. Kama ni 80%, you take 80%. If it is 70, you take 70. But when you have fair value of minority, you know minority plus parent is now 100%. So if you add parent and minority, you don't apportion the net assets, you take them in full. But if fair value of NCI is not provided, then that is called partial method. You will have to apportion the net assets. So another question, what are these net assets? Net assets are the equity. So ordinary, I'll write in short, ordinary share capital, share premium, retained earnings, and revaluation. Those are the net assets. In finance, net assets is assets minus liabilities. In accounting, assets minus liabilities is the equity. So when you are looking for the net assets, you take ordinary share capital, share premium, retained earnings, and revaluation, like that. Those are what you are supposed to consider. So we'll check them when we are doing that question. So that is okay. Allow me to go to number 2, just giving you the overview here. So number 2, unrealized profit on inventories. So in short, I like calling it UPI. UPI to stand for the unrealized profit on inventory. So you take the profit margin. This is how you calculate it. Profit margin. You take the profit margin, then you multiply. You multiply with the unsold inventory. So the inventory which remained in the store. So while you use that to a group member, then that group member failed to sell some part of the entire amount of the consignment. So to get the unrealized, you take profit margin, you multiply with the unsold. I saw in that question, the examiner was talking of markup. So to convert markup where you have been given markup, you have to convert the markup into margin. You convert markup to margin. So how do you convert markup to margin? For example, if markup is 1/3, margin will be, let me hear from you.
1/4.
1/4. Your numerator remains constant, but you add numerator to the denominator. Numerator to the denominator. Just like that. So don't work with markup. Also, in some questions, they will not mention it direct as markup. They will tell you it is profit on costs. When they mention cost, that is markup. Markup is to cost. Margin is to sales. So for unrealized profit, we don't use markup, we use margin. So in case they give you markup, you convert markup to margin. The next question will be, how do you adjust for UPI, that unrealized profit? How will you adjust it? So unrealized profit, you will subtract And let me just use the simple words here. You minus from group inventory. So once you calculate it during consolidation, you subtract it from the stock account, the group inventory account, and also you subtract from retained earnings. RE is the retained earnings. So reduce profit and also reduce the stock account. That is the consolidation adjustment for unrealized profits. Correct. Then allow me to go to number 3, unless someone has a question on up to where we have reached. Unless someone has a question there. If there is no question, then let's go to unrealized profits on fixed assets. Unrealized profits on fixed assets. I like calling it in short UPFA, unrealized profit on fixed assets. You take the profit margin, not markup, then you multiply with the sale value of PPE, sale value of PPE. That is how you get it. So if also they give you markup, you convert the markup to margin, which I've shown you how to do it. Then you multiply. Then now, how will you adjust for it? How do you adjust for UPFA? After calculations, UPFA, you will minus, it is a minus from group PPE, and also you minus from where? From retained earnings, like that. That is how you adjust for the unrealized profit on fixed assets. So in that question, I saw it also. It was there. So you calculate it, subtract it from the PP when you are doing presentation, then subtract it also from retained earnings. Then, in case, I hope you are writing or you are following there keenly, in case the group charges, depreciation on UPFA, then the excess depreciation should be calculated and adjusted as follows. You know, you find these people, like in this question we're going to do, we have already seen these people sold an item of PPE at a profit. Then they were charging depreciation. You're not supposed to charge depreciation on profit. That is very wrong. So if you charge the depreciation on that profit, it means you're charging what we call excess or depreciation overcharge. So it means the value of the assets are understated and your profit is also understated. So if the depreciation is taking place, then this is what you do. You say excess depreciation will be UPFA. How to get it? You take that excess amount, you multiply with the depreciation rates. That is how you get the excess. Then now, how do you adjust for the excess? You add it back, add to PPE. Also, you add it back, add to retained earnings, like that. That is how we adjust for excess depreciation. Good, good, good. So keep those notes safe. They are going to be very much applicable as far as that question is concerned. Perfect, perfect. So let's go to revaluation. Revaluation. So revaluation there's nothing much. This it arises, maybe you can write. Revaluation arises when the fair value exceeds the carrying amount. When fair value exceeds the carrying amount. So with this one, you just debit PPE, comma, you credit revaluation reserve. So if you have revaluation, that is what happens. Then once you revalue an asset, you need to charge depreciation. So you need to depreciate the revalued amount, the revalued amount if the asset is depreciable. If the asset is depreciable. So in case the asset is depreciable, you need to charge depreciation on that revalued asset. So revaluation haina maneno mingi at all. So here, let's not waste time. Then we have non-controlling interest, NCI. Non-controlling interest, in a consolidation, we check two things: their equity and their profit. Profit goes to the P&L, equity goes to the balance sheet. So in case you want to know how much equity is due to them, then this is what you do. NCI's equity, like in that question, is balance sheet. So you'll check equity. You check the fair value. You take their fair value on acquisition. Fair value on acquisition. Their fair value on acquisition. Then you add post-acquisition profits of the subsidiary. Post-acquisition profits of the subsidiary. So the profit the company subsidiary made after acquisition, you'll give minority their share. Then what you get is what you take to the balance sheets, is what you take to the consolidated. So you say to CSFP. The CSFP is the consolidated statement of financial position. So that is what you will take there as far as equity is concerned. As far as equity is concerned, the equity of minority, that is what happens. Then also, there is, I said, last sitting, those people brought consolidated balance sheet. We cannot be convinced that these people cannot repeat balance sheet, and also they can repeat P&L. Very possible. So it means I will do this one, then I look for another question somewhere for consolidated P&L, then we will be safe. So to that effect, NCI's profit, when you are dealing with P&L, you need to check profits. You need to check profit, which goes to the minority. So you take the PAT of the subsidiary, PAT of the subsidiary, profit after tax of the subsidiary, then you adjust for unrealized profits only if the subsidiary is the one who sold. Kama si wao, don't subtract. So you take away the unrealized profits on inventory. You also less depreciation on one condition, that the subsidiary is the one depreciating that asset. Then also you less impairment. So impairment, you subtract if NCI participated in goodwill determination. So whatever you get there is the adjusted profit after tax. That one there, call it A. Therefore, NCI is equals to their percentage. You take the percentage of NCI times A. That is the value of the minority. That is the value of minority. So you share after adjusting profit after tax of the subsidiary. That is what you give the minority shareholders. But for balance sheet, you just take their fair value on acquisition, you add post-acquisition profit. That is what you take to the balance sheet. But to the P&L, this is what happens. Correct. Then now we go to non-controlling is over. We go to intercompany trading. Intercompany trading is whereby, actually, it should be intercompany trading and balances. Intercompany trading, intercompany trading and balances, yes. So intercompany trading is where they sell goods amongst themselves. So those goods which have been sold, you eliminate them. This goods sold, that one take note, goods sold, you subtract them from the intergroup sales as intergroup sales. So when consolidating for profit account, you consolidate the sales, this plus this, then you subtract whatever they sold amongst themselves. That is what I call intercompany trading. So the value of the goods they sold amongst themselves, you subtract. Then the balances. Balances is now to the balance sheet. Na iko kwa hii swali tumeona that at the end of the year, there was this amount due to this, that. So right this way, intergroup balances should be eliminated. No, I don't know the word eliminated. Should be subtracted. Use that word subtracted. Should be subtracted from trade receivables as well as from trade payables. So if the examiner, like, check this question, easily to run up, you due from what to what, you subtract, but you only subtract between parent and subsidiary. Kama ni balance inashika associate ama joint venture, don't subtract. Those are not part of the group. You only subtract intergroup debts between parent and subsidiary. Very important. Let me use this to explain what I want to say. Check down there. A close check in S books revealed that the receivable of S had 30 million due from H. So in the books of H, which you can see here, the amount is 25. The other side, they are saying it is 30. It came up because there's a check of 5 million which had been sent. So that 5 million is called cash in transit. When the other party has paid, which has not yet been received by the other party, then that amount is called cash in transit. So down there you write, cash in transit is added. I don't want the word we adjusted or something. Is added to trade receivables. No, is added to cash book balance. Cash in transit is added to cash book balance, and subtracted from trade receivables. Subtracted from trade receivables. Subtracted from trade receivable. So if the other party is claiming they have paid, go and add it. During consolidation, when we are preparing the balance sheet, you subtract it from trade receivables, then you add it to the cash book. So that is well noted. Investment in associates and joint ventures. Joint ventures and associates, they don't go to the balance sheet. You will not be consolidating. What you bring is the investment peke yake. So how will you get this investment? And this one can also be required. So you take the initial investment, what you invested initially, initial investment, you bring it here. Then you add post-acquisition profits and reserves. If there is any reserve which came after acquisition, you add them here. You add them there. Less impairment. So if the investment is already impaired, less impairment, loss. If there is any impairment, though that is quite rare, if there is any impairment, you subtract. Then this is the investment which you take. You take to NCA, to non-current assets. So in the balance sheet, you take that one to non-current assets, like that. So those are some of the adjustments you're supposed to know as far as consolidation is concerned. I think that is enough. In fact, with that overview, we will be ready to handle now this question here. So I hope that overview was necessary for you. So I beg that we stop at that stage. Then when we meet in our next class we are meeting on Friday, because tomorrow, we were supposed to meet tomorrow, then Friday, but tomorrow I will not be able. I'll not be able to meet you people. Let me stop sharing. And even I can mute.